Well, Mark, the S&P 500 Home Building Index is up 21% year-to-date, but up just marginally for the year. What's driving this recent rally? Not fundamentals, according to Michael Widner, an analyst with Stifel, Nicolaus and Company. Michael joins us now from Baltimore with more. Welcome, Michael. So, Michael, if it's not fundamentals, what is driving this rally?
Well, these stocks for going back about 18 months now have traded much more on economic sentiment and are we close to the end of a recession, what kind of recovery are we going to have in the broader economy, much more so than on fundamentals in the housing industry, at least for the most part. I mean, certainly housing trends do have a complementary role, but for the most part it's been really swamped in our view by the broader trends in the economy.
And do you think this rally is sustainable, or do you think people should exercise caution?
Well, we would definitely advise caution here. If we look at the rally that we've seen over the past few weeks, which has been very powerful, it's mostly been driven by some strong numbers that we've seen in economic data in July. Really started out with some strong employment numbers earlier in the month, continuing mid-month. Broader market earnings have generally beat, not within the home builders, but across the broader markets. Home sales were up, new home sales were up, home prices improved modestly month over month. And really the consensus view on the economy seems to be gravitating toward the fact that we've ended the recession near the end of Q2 and that we're looking for positive GDP growth in the second half. The July data has been good, and we're very tentative about the data that we're going to see over the next couple of weeks.
Michael, it's Mark Crumpton with Patricia. These stocks, have they been caught up, in your opinion, in early cyclicals? Is that what's going on here?
Well, I think that really is the case and has been for, again, the past 2 years. Rallies of this magnitude are not unusual in this group. This is the 7th rally that we've seen that's been 25% or more in the span of a couple of weeks. And it really tends to be kind of on a repeated basis the early cyclicals play. Every time the market believes that we're close to the end of a recession, it's time to buy early cyclicals. The builders are the quintessential early cyclical, so the money pours into the builders.
So this isn't unusual then, is it?
Well, in my view, it's not unusual. I mean, again, we've seen, this is the 7th rally of this magnitude that we've seen in the past 18 months, so it's really not that unusual. I think that the challenge now, as you asked, is, do we have the data that follows through? And so if the data over the coming weeks, we'll see unemployment data this Thursday, we'll see GDP data for the second quarter on Friday. If those continue a positive trend, then perhaps this rally has some legs and it may be sustainable. We're still cautious on that data, and then, let's remember the main builders have not yet reported 2Q, and so we'll get Ryland earnings, D.R. Horton and Pulte all reporting in the next week. So that should give us some clues as to what, real builder earnings are going to look like. Meritage, not exactly a stellar result last night.
Now, Michael, you just mentioned D.R. Horton. You had upgraded D.R. Horton and Toll Brothers recently from sell to hold. Something that you want to tell us?
No, when we rolled out coverage on this group, we recognized that it's a combination of both fundamentals and really sentiment that drive the stocks, and in the near term they tend to move much more on sentiment. And so our call to upgrade these stocks, early in this month, early in July, was mostly because we saw this coming. I shouldn't say we saw this coming. We didn't expect the rally to be this magnitude, but what we did expect was the data to look largely better in July than it had in the past months. And, we wrote about that. We expected the employment data due to seasonality impacts to look good in July.
Right.
And really all the broader market needed to do was hit earnings. They didn't need to beat. They just needed to hit earnings. And that, again, is confirmation of the group that it's time for the early cyclical play again.
And Michael, in about 20 seconds, can this rally be sustained?
I think what we need to see to sustain this rally is a true V-shaped recovery in the economy, and my gut feel and all of my economic data tells me that's not going to happen. I don't believe that flat GDP in the second half and 1%, 2% real GDP growth next year drives this rally higher. So I'm cautious here. But, we'll see when we get the GDP print at the end of the week and as we see earnings out of these guys.
Mike Widner of Stifel, Nicolaus and Company joining us this afternoon. Mike, thanks.